Welcome, student, to the Millennium Academy. Today we are going for the part two, and we are continuing the solvency ratio now today. So, solvency ratio is about that what company is going to pay non-current liability or not, whether company can pay non-current liability or not, right? So that when we talk about the non-current liability, we have the loans, bonds, debentures, notes payables, and preferred stock redeemable. If it is redeemable, it means that there is a maturity date to pay. So that you can include in the basically non-current liability. You have to remember that, and its dividend you have to show as interest. Okay, understand, Mr. Shah?
Yes, clear.
That's right. So now when we see there what type of ratio that we can see in that, so we can see the debt to asset ratio. Debt to asset ratio means your total debt and total assets. Debt to asset ratio. It means we can say that what is the proportion of debt there out of total worth, that is total assets of the company. Then we have total debt to total capital ratio, right? Total debt, again the total your current and non-current liability, that is total will be coming, and that it means the total debt to asset ratio or debt to capital ratio is the same. Agree?
Yes, the
It
same.
it is the same thing, because total debt means current liability plus non-current liability, and total assets means asset is equal to liability plus equity, right?
Correct.
In
Yeah,
fact,
correct.
they are the same. In fact, they are the same there. And next, we have to see the debt to equity ratio. What is the proportion of debt and equity in the total capital structure of the company? So that tells about that. Basically, they are telling about the gearing. Gearing means the dependency of the liabilities in the capital structure. So when we talk about the capital structure, it means we say that how much is the one means the debt and total financing of the company, right? So capital structure means total financing of the company. It means debt plus equity. Both of them are there. So when you say debt to equity ratio, it will tell the proportion of how much is the debt and how much is the equity. The other ratios are long-term debt to equity. So it means we are going to look over there only long term debt. Basically, if you take the how much the borrowing a company has done, right? So that normally is a current liability. It means in the because what we have the current liability in that we can have accounts payable, we can have salary payable, we can have income tax payable. Many things will be there in current liability. That is not basically interest based, right? That is not
Correct.
basically interest based there. So that is why we find out the long term debt to equity ratio. So of the long term debt, how much is equity proportion? Then we find out that because when a company takes the loan, so it has to be able to pay the loans as well as the interest in time, right? Every year the company has to pay the interest. So and that, for example, if bank is giving the loan, so bank would like that the company's ability to pay, that they say whether they can pay the current liabilities, how many times they can pay non-current liabilities out of the debt or total assets, as well as they have to see that how much the interest, how many times interest they can pay out of their profits.
Yeah,
So higher higher ability to pay, it means the company is sound, right? So if the coverage ratio or interest on ratio is higher, so it is better. Then we have the financial leverage ratio. Financial leverage ratio, we say that assets and equity ratio. Assets and asset to equity ratio. This is called the financial leverage ratio. There are so many other leverages that we are going to find out, right? So operating leverage, financial leverage, we will find out those. So and the particular four formulas are there for leverage calculation that we'll do it later. Cash to fixed asset ratio, cash flow to fixed charge ratio. So how much the operating cash flow you have, right? Plus tax payments divided by fixed charges. Normally, we say that here we talk what was the formula? EBIT means earning before interest and tax. Earning before interest and tax, EBIT divided by interest. It means how many times you can pay interest from EBIT, earning before interest and tax, right? So you always have to take EBIT figure, not net profit, not EBT, EBIT, because before interest and tax, because interest you have to pay, so it should be a profit should be before interest. Then you can come to know that out of, because if you say net profit, it means already you paid the income, interest and tax. So that means already you paid one time interest. So that you will take EBIT there. So if you say interest coverage ratio, it is divided by interest expense. Whereas cash flow to fixed charge ratio, it is divided by all fixed charges. All fixed charges. So fixed charges can be some lease payment, can be some interest payment, can be, so that we will include those things. So anyway, let's start. We will go to the formula solvency ratio. Here is the question what we have. Right. So debt to asset ratio, that means total debt. To total liability, how much we have in this question?
Sir, sorry, one small question here.
Yes.
The employee end of service benefit and the employee gratuities, employee related obligation, these are also non-current liabilities which will be considered here.
Yes. All non-current liability. Right.
Okay,
All
okay,
non-current liabilities. Right. So
fine.
all. So here we have the non-current liability, current liability 390, non-current liability 610. Total becomes 1 million. Right.
Fine.
So if you see the total liability means current plus non-current. So obviously it will include all of them. So 1 million divided by total assets. So total liability divided by total assets. So total assets, you can see there are how many? 1.8 million. Either you take from the asset side or you take from the liability and equity side, it will be same, right? So
Fine.
1 million divided by 1.8 million. So it will become how much? 56%, right? It is how much? 56%. So can you tell
56%.
me how we can calculate for prior year?
Prior years, the 950,000 divided by 1.6 million.
Divided by,
950,
yes,
950 divided by 1600.
divided by 1600,000. So that will come how much? 59%. So what do you think about these ratios now? So this is the current year, right?
Yes, sir, this is the current year.
And this one is the
Previous year.
prior year, right? So what do you think? So the company situation is getting better or it's deteriorating?
The
59% become 56%.
total liability. So it it seems the liability is increased over the period, and the total to debt to total asset is actually decreased.
So it's better or not better?
Looks like it's better, sir.
No. See, we are keeping total liabilities up,
Okay.
right? So we are calculating total liabilities out of total assets. Obviously, total liability should be less, right? That
Yes.
better. If total liability you have, because we in the total assets we have two things, liability and equity, right? So
Yes.
which
Yes.
proportion should be more, liability or equity? What will be better, liability more or equity more better?
Equity more is better.
Equity more better, right?
Yes.
So here
Yes, sir.
you can see that 59% has become 56%. It means liability is reducing, so it's getting better, right?
Yes. Yes. Yes.
You mentioned better or what?
No, I mentioned the other way that
Yeah,
yes, I told it is better actually, but we are thinking that it is not the better. It's the other way.
yeah. No, it's better. It's getting better because the
Fine.
liability is reducing, right?
Yes.
So
Yes. Yes.
liability 59% was there, now it become 56%. It means the
Yes, sir.
proportion of liability is decreasing and proportion of the equity is increasing. So that is getting better, right? So
Yes,
that is
it will.
getting better. So there. Okay. Now debt to equity ratio. So debt to equity. Debt means total debt. Total debt. How much we have?
One total that means the or that will take only the non-current liability or current liability also.
Hmm? Where is coming debt? So you should consider the total, right?
Fine, fine, correct.
Otherwise, it will mention just like long-term debt to equity. Okay.
Fine,
So how much debt we have? 1 million. Equity
one
we have
million
how much here? This is equity. Total how much?
800.
800. So 1 million divided by 800, that is 1.25. What about the
Yes.
prior year?
Where here we are having the 950
Hmm.
and divided by 650. It is 1.46.
Hmm. 1.46.
So
So what do you think? So from prior year to the current year, is it getting better or worse?
looks like it is getting better also.
Hmm. Of the liability, of the equity, assets were before, right? If equity was $1, so liability was 1.46, right?
Yes, sir.
Now, if liability is $1, so equity is liability, if equity is $1, so liability is 1.25. So liability is reducing. That's better, right?
Reducing. Yes,
That
yes.
is better. That is better. Now, long-term debt to equity ratio, how much long-term debt we have here?
The long-term debt we are having here 610 in the current year and 675 in the past year.
610 long-term debt
610,
we have, and divided by equity. Equity is how much? 800.
800
6,
current.
610 divided by 800, right? So that we
Yes,
got 76%, right? And
correct.
here it will
Correct.
be how much?
Here it will be 675 over 650. So it was 1.03.
1.03. So is it getting better?
Long-term debt to equity.
Hmm.
Yes, looks like this is also getting better. Yes.
So we say, so it's all getting better, right?
Yes.
So it's getting better, it's getting better, right? Then we have the times interest earned ratio, right? Times interest earned ratio, what is the formula? EBIT means earning before interest and tax divided by interest expense. So let's come here. This is the income statement we have. Hmm?
Okay.
Or
So
let's
the EBIT is EBIT is 80.
because this is the new one I'll bring here, right?
Right.
A little change in that, but let me. 269. Okay, because in the 820 change. Okay, right. So formula is EBIT divided by interest. So how much EBIT we have here?
EBIT is 150 for the current year.
And interest is
One and the interest is 15.
50. So 150 divided by 15, right?
Yes,
So it is
is 10.
15, 10, right?
Yes.
What about the prior year?
Prior year number was the 125 and 10. It is 12.5.
125 and 10. So it's coming how much? We round off, it is coming
13.
12.5,
12 plus 5, yes.
right?
Yes.
So, what do you think? So, is it better or not? Now it's better or
Uh,
before?
I said earning before interest and tax and the interest expense. So it is reducing. So
Right.
I think it is better also.
No. Before,
No?
our profit, maybe it is profit.
Yes,
If
sir.
$1 interest, then 12.5 was the profit, right? In order to pay
Correct.
$1 interest, we had the $12.5 profit.
Correct.
Right
Yes, sir.
now, for $1 we have only 10. So it's deteriorating, right?
Correct. Yes, sir. So it is reducing.
Right. So this is what we understand to the here solvency ratio, right? So solvency ratio we discussed about, this is there. So here if you see, now these ratios already we discussed: current ratio, quick ratio, asset test ratio, all we had discussed. Capital structure, right? Debt to total capital ratio, total debt to capital ratio. So this is what we have. We discussed already, it was 0.56, 0.594, right? And here we calculated debt to equity ratio. It's the same, 1.25, 1.46. We got it. Then we discussed the long-term debt to equity ratio. Then debt to total asset ratio, it will be same. So debt to asset and debt to capital ratio are same, right? So
Correct.
what it report the total debt burden carried by the company per dollar of assets, right? Of that earning coverage or interest cover ratio times interest run ratio. This is same. So we discuss it's 10 and 12.5. Right. Earning to fixed charge ratio. Earning to fixed charge
Yes.
ratio. So earning before fixed charges and taxes. Right. So it includes the interest portion associated with long-term lease obligation. Right. So when we calculated the interest cover ratio, we divided by interest only. Right. But here it will include the interest earn ratio to include the interest portion associated with long-term lease obligations, right? So suppose if you are making a lease obligation or lease installment payment of 100,000, in 100,000 there is a interest payment of 20,000, suppose, right? So that
Okay.
20,000 on the lease, that will also be included in the fixed charge. Got it?
Okay.
So that you should understand the fixed charge ratio, and here not EBT only, earning before fixed charges. It means when you're taking, let's say if I create a question here, right? Let's see if there is an income statement. Suppose the same thing I create, I just make it here. We have the net sales. Okay, this is I have created the complete thing. So let me copy the all of them same. 1800, 1000, 1450, 1000, 350, 1000, 1000. Other revenues are missed out. So VAT is 1000, right? And we have just 15,000. So what I'm doing for our fees, that is 10,000, and this one I am keeping 5,000, right? Okay. So otherwise it will change. Hmm. So EVT will be how much there? 135,
Multiply.
and tax is 54,000, and net income will be 81,000, right?
Right.
So this particularly I created for interest cover, interest fixed charge ratio, right? So fixed charge ratio formula, I told you that fixed charge ratio, right? So fixed charge ratio, earning before fixed charges and taxes divided by fixed charges, right? This particularly I created. So obviously because interest cover ratio we calculated by 15,000 was the interest only, right? But now I'm keeping the 10,000, right?
Understood. Yes.
So this is only for fixed charge ratio I have created. So there's a difference will be coming, right?
Correct.
Fixed charge ratio, right? So what is the formula? Uh,
Earning before interest and tax
earning
and
before interest
interest tax and before fixed charges.
and
Fixed charges.
charges, right? Divided by fixed charges, right?
Fixed charges. Yes.
So this is okay. So here we can calculate that. So it will be how much then? EBIT
150,
hmm,
150 divided by 10.
divided by
10,000.
not 10, 10 plus 5, 15.
No,
Okay.
sorry. Fixed charges only. I think
That's
the
plus interest on lease payment, right? Both
yes,
of
yes.
fixed
Right,
charges,
sir.
right? So
Correct.
that will be coming 15, right?
Correct.
Okay. So this is basically we calculate interest fixed charge ratio. And there was another formula that we had, cash flow to fixed charge ratio, right? Cash flow to fixed charge ratio. Here we had discussed that how much was the operating cash flow was. Let me bring this one here. So our cash flow is here. Okay. So now we can calculate cash flow to fixed charge ratio. How we can calculate here? What is the formula? Operating cash flow divided by fixed charges, right? So In our case, operating cash flow is given 382,000. Fixed charges
And
are 15,000, right?
15,000. Yes.
So we can calculate 382 divided by 25, right?
Correct. Yes.
So this is the 25. We have the 25.5 is the average. So we calculated all the formulas which were there, right? All the
Mm.
formulas calculated. Financial leverage ratio, uh, we have later I have. So you have understood, then we'll come to the financial leverage ratio. Understood
Okay,
that?
sir. Yes, sir. One question here, please.
Hmm. Yes,
Sir,
please.
this the word we are using here, fixed charges. No? So, is it mean only the fixed charges which are having some connection with the interest, or any kind of fixed charges? Like for example, we are having the leases also normally in the company, where we have the fixed charge. One common example is the building rental of the office. So fixed charge is there for over the like for maybe for the next 10 years.
Hmm.
Okay, and then the we are having some other fixed charges like
His
the
rent is
freelancing.
there, rent is also there, insurance is there, many of them are there, right? So
Yes,
we
yes.
have basically when we'll calculate the leverage ratio, in that we
Yes,
will consider the both aspects, operating leverage and financial leverage. So here particularly we are fixed charges, we are particularly addressing interest related, right? Here
fine, sir.
interest
So
related. So when we'll go to operating leverage, then we will see those. Okay.
fine, sir. So in this formula, fixed charges mean only the fixed interest. Actually, we can say in simple words this way, like it is just the fixed interest associated with the fixed charge.
Yes, kinda you can say. Kind.
Fine, fine.
Okay, so here we calculated the fixed charges ratio, right? Hmm.
Okay. And
Little
sir,
confusion is
one
there. This and this is remaining same, right? 10.
yes,
Okay, sorry, it was 10, right?
yes, it is.
Because I was taking the book question, and in the book they did not mention any interest on lease payment. So I say it will be disturbed. So I made a 10 and 5. So otherwise it will affect it. Or otherwise I should make it, for example, this one 15 and additionally interest 5. So it will affect our profit, right?
Net profit. Understood. Yes.
That will affect there, right? Or I should not be looking on that one. So it will differ from the book, right? It will differ from the book. Better I should make it like proper, because otherwise when we see, hmm, so what I'm doing, I am making this one minus 15,000 and this one 5,000. So effect will be 150. So I'm not looking at the book one. So we are creating our kind of own, right?
Yes.
So that is becoming 150. Okay, it becomes double minus, right? Because already I put minus with those. So we can say 150 minus 15 minus 5 become 130, 130 and minus 54.
31. Yes. Yes.
That's making this. Okay, so 76,000. So our profit is differing with them, right? But right, so I am erasing this one. Okay, this is our income statement. So it should look proper. So from the book, it will be different. So now it will be divided by 20. Okay,
Fine.
right? So this is
Fine.
what I have done. So it should look better. Otherwise, means the interest cover ratio was coming 10 and fixed charge ratio was also coming 10, although there was a lease interest was also there, right? So
Correct.
that's why I made some changes there. Okay, so this is the difference there. And if you want to calculate, let's say the previous year, I think I deleted it. So let me make it 1400,000 minus 1170. So 30. 14 minus 11, 22, 30 minus 50,000. So we can see 230 minus this figure 150 minus 25,000. That is what? 150 minus 125, and interest payment is 10,000, and interest on lease payment I am keeping same, minus 5,000. So that will be what? 110. So there's a difference will be coming as per the book. And tax is how much there? So how much the tax was there? 135 become 54.
Okay, 46.
13.5, 27. It was 40%, right?
Yes, sir.
So it will change, right? Because I was keeping same 54, but our 5,000 I've had it, right? So I have
Correct.
changed 40%. Is equal to 110 into 0.4. So this is the figures have changed, little, right? From our book, because we are accommodating the fixed charges as well there. So
That's, I think, minus figure.
yeah, okay. I put a double minus. I put it minus. Okay. So 110 minus. This is our figure there, right? So
Yes, sir.
we'll keep this one as well if any question arise. So now we had how much our we discussed basically 150 divided by 20, right? Now we'll do 125 divided by 20. Okay, the earlier one. So
Yes, sir.
here we can do what? 125 divided by 20,000.
20,000.
So that will be 125 divided by 20,000. That is
Yes.
coming how much?
6.
10 and 6.3, right? This
Yes,
is
sir.
the fixed charge ratio. If we come to other formula, for example, cash flow to fixed charge ratio. So let's come there, cash flow to fixed charge ratio. Cash flow to fixed charge ratio. So operating cash flow is given here. Where is that?
Down we use him. Yes.
So
382 into 91.
382 is that divided by 15. No, total I make 20,000, right?
Right.
So this is it will be coming cash flow to charge ratio. This will be the that will be coming there. So what about the last year? Uh,
Two,
Fixed charge
290.
are 15 now, right?
Yes,
And
sir.
how much operating cash flow? 291, right?
291. Yes.
291 divided by 15. Divided by 15,000. 20,000 was there, 15 was there. So that is coming how much? 19.4, right?
Correct.
So this is cash flow to fixed charge ratio also we calculated, and that we have come to know, right? That we have come to know. So okay, I wanted to have a color. Okay. So this is it. So this is the formula that we have calculated there, right? So any confusion you have this? So we have done all the formulas related to the this. Okay, related to that we calculated. So all the formulas which were there related to fixed charges, solvency ratio, all we have